Hi, everybody. Thank you very much for joining us to this webinar. Thank you very much, Mingkun, for being with us since, as you know, he's based in Shanghai, so it's a bit late over there. Hi, Mingkun. How are you doing?
Hi.
So,
Good morning, everyone.
First, before the turn of Mingkun, we're gonna do a quick review of the current situation of Cobas. So as you know, here are some key figures. As of today, we are managing 15 vehicles divided between Luxembourgian funds, Spanish funds, and pension plans. We're currently managing also 1.7 billion with almost 50 million of inflows in this 2022. Next, we will talk about the performance of our funds. It is true that we're having negative returns since the launching, but during the last couple of years and above all this year, we're having a much better performance than our benchmark and than almost any other index in the market. And we're not having just better returns than the market by itself, but also compare to the value. And that's why, as you know, we've been invested in the same investment thesis for the last 5 years. All the thesis has been evolved in a very solid way during the last couple of years, and we're more convinced than ever that we're gonna reach the upside of our funds. Talking about this upside, we're in the best moment since the launching of the funds. Despite this good performance during the last couple of years, we're now in the situation where the gap between the NAV of our funds and what we think the value of our funds is wider. Why? There are a few reasons. Some of them because we tend to invest in business where we have a visibility of 10 years in the free cash flow and in companies that have great ROCEs. As you can see, we have a 30% of returns of the capital invested in from our companies. We have a free cash flow yield of over 27%, which means that it's 4 years these companies are generating what we've paid for them. Other reason is that the volatility we've been through along this year, it opens continuously opportunities to buy and invest in companies at better prices. And other reason is why the way the investment team has structured the portfolio during the last years. It is true that we've been talking about that inflation was going to come for a lot of years. So the investment team created a portfolio which has the capacity of absorbing this inflation in an inflationary situation. We think that after all this aggressive in the monetary policy that we've been through in the last decade, it was evident that this inflation was going to come. But it was more, these policies were even more aggressive during the last couple of years. So during this time, the investment team wanted or founded the companies that or organized the portfolio in a way that we're more than protected against this inflation. So here are the main blocks that protects us against this inflation. At first, we have this 17% in commodities, which, as you know, they have the capacity of translating instantly this inflation. As you know, we don't tend to invest in commodities because, as I said before, we tend to invest in business where we have this visibility of free cash flow in a 10 years time horizon. But we're taking profit of inefficiency in the market, as you know, in the oil and gas sector. We also have this 50% of the portfolio which is inflation resistant because our companies which has competitive advantages, so they can translate this increase in the prices, or because they have contracts linked to inflation. And lastly, we have these defensive businesses that has very good performance independently of the market situation. From this moment, now is the turn of Mingkun. So please, Mingkun, thank you very much.
Hello, hi everyone. Pleasure to talk here. So let me just continue Arvin's presentation. So in this page, we are trying to compare the fund in terms of weight. So basically, compared to 3/4 before, we actually reduce some energy exposure, and while adding some cyclical exposure here. And the reason being, you know, as we are value investor, as the energy stock start to performing, and we have to sell some. And then we take advantage of the industrial cycle coming in the lower part. So there is some company that was showing tremendous value. So we bought some cyclical names there. And to perhaps one key point in this slide will be looking at the energy sector, where we have almost like 40% exposure, and only 12% of them has actually exposed to the oil price. So that is the oil and gas producers, and the rest, LNG infrastructure, oil service, transportation infrastructure. Actually, many of them are has this fixed contract, or is in a situation where the supply and demand is in favor for the company to increase price. So that's very different from actually speculating on oil price. Just want to mention that. So perhaps next slide, please. So on this slide, this is our typical top 10 holding of our fund. I guess many of us already know this through our regular press. So I would like to touch these slides in a very different way, in the sense that I like to talk about how could Cobas with the analysts based in China, in Asia, help our fund, help our portfolio to better manage the money. So, for example, our number one holding, Gola LNG, and it is just about the LNG demand. Well, it's a floating LNG supplier, right? So, and the story behind is we actually need to watch the LNG demand and from a long-term perspective. So being able being Asia, I know we can actually tracking the demand in especially the big demand from China, where the coal as a percentage of energy source still more than 50%, almost 60. So you can see that it is a lot of potential for LNG or gas to increase. And then also you see in Japan and Korea, which is the number 2 and number 3 LNG demand comes from. I mean, they have a very different situation. It's more mature economy, and they also have some option of nuclear, etc. But you can see that their infrastructure is there, and then gas is already part of their energy structure. So this is not going to change in 5 years' time, for example. So that's one thing, one angle for LNG. And if we move on, SIA is most European business, Papco, Gori is European, and Maritime is oil and gas ENG supplier. So for this, we actually observing many competition from Korean. They are Korean company where actually increase their competitiveness in these sectors. So this part, we also monitoring the competition in Korea for Maritime. And we Hansen, this is a car shipper. You know, they have big ships that are moving the car globally. And one of the interestingly, one of the asset we Hansen own is a joint venture with Hyundai Globis, which is the other car carrier company belong to Hyundai Group. So in a sense, we also do our research on Hyundai Globis and also helping on the Winhansen story. And for Daniele, this is steel equipment, especially for the electric furnace provider. And for this one, we actually see in China, you know, in China, there's a huge demand for the electric furnace. It's going to take a long time because structurally it's not very favorable for China to use electric furnace. But because of environment reason, we already see some company already trying to studying this possibility, and we believe that Niele is well positioned in this sector for that reason. And Renault, the auto company, we certainly we compare it to our other investment, Hyundai Motor, and also very important in China. There are many in the new EV electric vehicle era. There are many new entrants from China. For example, NIO and you name it, BYD. They are trying to even now invading into Europe. So this will be being in China will help us to kind of compare apple to apple to see what is the advantage, what is the disadvantage, and also if those business model are sustainable for the competition. So we will have a better sense here. And EXMA is a very similar story to Gola. It's about the natural gas LNG demand. So also that's very helpful as well. So moving to the next slide, perhaps it works for us to talk about the current Asian investment overview. So let's give the snapshot of the Asia holdings. So basically, we're holding about 11 Asian company. That is about 9 to 10% of our 9 to 10% also global Cobas selection fund. That's one, and a couple simple numbers. All of them is family owned, so there's always a family behind, or at least a group of control. All right. And second point, those are really good business. With a ROCE in the range of 25% and very solid balance sheet. In fact, 7 of 11 company we own, they are in net cash position. So we don't need to pay attention to the financial risk at all in those situations. And lastly, they are trading at very decent valuation. In aggregate, you are trading at 3.5 times PE, roughly about more than 200% upside. So that is a very broad glance for the Asian company we own in our portfolio. Perhaps next slide. Yeah. So here, these are the company that we own for the Asia part, and maybe I will just go through them one by one with some key update for you to understand. So first, Samsung C&T, we own 1.6%. This is in fact a Samsung Group holding company, and one of the biggest asset of the holding company is Samsung Electronic. It's about 75% of the sum of the parts valuation in C&T. So the electronic business is the most important value in the company. And for the electronic part, about 50 to 60% is memory. They make money from the memory business. So it makes sense to let's look at the memory business. So this is a business that throughout the history already become oligopoly. There's only 3 players, important players. Like in the US, we have Micron. In Korea, we have Hynix and Samsung. So basically, 3 of them are in the DRAM sectors. And one of the important thesis for Samsung case is the supply discipline is improving a lot, and at the moment we're actually probably seeing a demand kind of slow down after the COVID-driven demand kind of overhang. But effectively, what we are expecting is happening where the suppliers start to reduce their capex and are looking in the next year. Hynix was reporting yesterday. They announced they will cut probably more than half of the capex from 2020 to 2022. And Micron report a week ago. They said a similar thing. They will try to slow down the supply. So and Samsung report today is not totally clear, as they always not do so. But I think they are also in the same tone that the next year, 2023, perhaps the supply will not grow, perhaps zero. but the demand will recover. So they will rebalance perhaps in the first half or second half of 2023. So that's the very key thesis of our Samsung story, and of course we are keep watching, and there's no reason this will change. So that's the first point. And second point for Samsung is this business is not easy. It requires a lot of investment. I don't know if it makes sense to you. You know, recently the US want to attract new player to go there to set up a fab, and the fab is costing multi-billion US dollars. So the entrance tickets is very expensive, and because of this technology advance to a level that only few players can survive, and that's the thing. This is there's a mode for this business to sustain with certain level of profitability. Otherwise, nobody makes money and nobody invests, and there's no supply. It's very simple. And lastly, I think again, safe balance sheet. Samsung has about almost 100 billion US dollar net cash on its balance sheet. This is about 30% of its market cap. So we are hopeful that they will have a new updating shareholder return policy very soon, because in the last one, they actually do special dividend after they actually commit half of the free cash flow to either shareholder dividend or buyback or and buyback. So I think they will continue to do that, and let's see what that happens. So that's the case for Samsung, and then the next one is LG. So LG Electronics, to be more specific. So I think we talked this before, but basically they have multiple business. They have this TV business, and then the home appliance business. The home appliance business is a really good business, and you know the product cycle is kind of long. It's not like a mobile phone you change every 2-3 years. Your vacuum cleaner, your air conditioner, you didn't change it unless it's broken, right? It could be 8-10 years, and the company, the supplier, do not need to put expensive R&D money to make a new product. You know, they always some small innovation that is not very expensive to have a new product, and then to attract the consumer to buy. So this is a really good business. We witnessed this from many companies. The Chinese one, Media, Gree, and Haier. The US one, GE, which is already sold to Haier now. They all made a very good ROCE throughout the cycle. So this is a very good business. Well, however, we are now again after the COVID-driven demand overhang. So there's a cyclical point here, and that's why the stock is coming down, and that's good for us to buy more. And it also has a auto parts company business. That is very interesting because you know they leverage their technology in home appliances, washing machine, for example, to make the motor, and they use this motor to enhance and then use it in a EV motor, traction motor. So they actually have partnered with Magna, which is a tier 1 auto parts supplier, and then win a couple business from the GM, Ford, etc. And the business was just turning around last quarter, and we assume this will be a very good growth driver looking forward in the future. And the other point for LG that we mentioned last time was about the improvement corporate governance. And it's very simple. We see that they exist. They get rid of the loss-making mobile business. And then there's a huge boost to both the share price, also the profitability. And we can see that the management already, you know, trying to focus on the limited resources, capital, into the right place, like the auto parts that they see they have opportunity. Even they have opportunity even because they have this LG battery business that supply to EV big way. So there's kind of synergy in between for LG to grow in that regard. And lastly, for LG, we actually invest in LG Electronics for the preferred share, which again has this incredible discount to the common share. It's about, I think it was a 60% discount, which is abnormal, very abnormal. Samsung discount is about 20%, and Hyundai is 40-50%, and this one for LG was really incredible. So we do like this margin of safety to give us a very good protection. And the next one is Daiwa Industry. In fact, this is a Japanese company that we found a couple years ago. They sell the commercial refrigerator to restaurant mainly, and it is a very stable business with very good ROCE because of the service attached to the equipment is very sticky. For example, you will not imagine that the restaurant has their refrigerator broken for even half day because all the material will go bad immediately. So those kind of things need a very good and quick immediate service from the supplier. So they normally have this maintenance agreement or a team very nearby, etc. So that make it a very sustainable and a very stable business. And for Daiwa, I think it's kind of our play in Japan, where if you look at Japanese market, there are a lot of chip company and a lot of company that has their net cash as big percentage of their market cap. In terms of Daiwa, the net cash they own is about 80% of their market cap, which is, you know, again abnormally high. So we think Japan will be an opportunity when the world in US and Europe or even now China with a lot of debt, slow down growth and some risk in terms of leverage. Perhaps Japan will be a safe haven for many investors in the future. We don't know, but that's one of the bets that we have here, and we do like the business. That's the first point. The balance sheet and net cash is an extra benefit for us. Next one, CKH. I think we're gonna talk is in more detail in the investment case later, so we're gonna skip here. And Hyundai Motor, well, it's an old friend of us, and I think it was to mention that they have been changing their volume strategy to more profit driven. As every automaker now, they have a very good profit because of the shortage, thanks to the ASP and the SUV mix improvement. And the other thing I want to mention about Hyundai was they have very good EV product. I attributed that to you know, in Korea they are more, also in Japan and part of Taiwan, they are more electronic or software engineers here. So I think they are very quick in adapting to the EV product, and it has been proven their EV product is selling really well, especially in Europe, also now in US. I think they are targeting 10% market share in 5 years time for the EV. Versus the 5% market share they have in the ICE car. So that's a huge jump, and then I think they are on the right track. Now the models are selling very well. And the other thing I want to mention about Hyundai is they have very good position in the emerging markets. For example, they are the #2 market share owner in India, 1.4 billion population in India, and they are #4. So the potential is there. And also in Indonesia, they are just setting up a joint venture for the battery with LG there, taking the advantage of the resource, the nickel resources in Indonesia. And also in Indonesia, you have, I think 200 million people. So another populous country in Asia, where if you have a base there and a very close supply chain there, I think build up your brand early on. That's kind of, you know, very long-term perspective they have this for their future growth and business. And we do like that perspective in Hyundai Motor. And Okamoto, this is the other Japanese company that basically they have two business. Number one is industrial one. They made everything from, well, it's really complicated. So let's their core technology is to make the plastic very thin, you know, like very thin. And with that technology, they produce so many things from glove, sheet, skin for the car, in the car seats, for example. That's for the industrial part, which is, you know, mediocre business, let's call it. However, they have this consumer business, which they sell many things, and one of it, the most important one, is content. And so you can imagine why they can make plastic so thin that they have a brand, Okamoto brand content is number one in Japan, and they have very good reputation and also brand name, brand powers in most of Asia. And in China, I think they are competing. They are number two, just behind Durex, which is the other company listed in UK. Sorry, it's part of the other company listed in UK. So they have a really good position in the content business in Asia. And in China, they are number two. And there's a growth potential versus the developed Asia, Hong Kong, Taiwan, Korea, Japan. So I think this is a kind of a hidden gem here. And then on top of the business, net cash position, this is a real company in Japan where they do buyback, and the management team like to buy back. They see their valuation, their share value undervalued, they buy back. And there's a family behind who has been there since the founding, the company was founded. And next one, VTech. Perhaps this is the one I will mention because it takes too much time. So VTech is a Hong Kong listed company, but most of their business is coming from Europe and US. And they are three business. Number one is toy. So they are trading with the brand name like Leapfrog. They bought it, and also the VTech. And their toy is for the age between like 2-3 years old to like 11-12 toddlers, they call it. So those one very important business for VTech. And we like the toy business because this is a kind of very recession proven, recession-proof business. You know, the item of toy is, you call it $10, $20 things, and but you know, in recession, this is probably the last thing the parents will save for their child. You know, you're not going to save $20 and your child will cry, right? So this just as Mattel and the US listed Hasbro, the toy business has been in the cycles very resilient. So we do like this part of the VTech business, the toy one. And the other two business, one is the phone, which is, you know, they're just maintaining it because after they are making the fixed phone. So this is you know, mediocre business. But the other OEM business, they are in a niche position in the electronic OEM business. Not try to compete with the big guy like Foxconn and doing OEM for Apple, iPhone, iPad, MacBook, whatever. They are trying to focusing on the niche market. For example, they manufacturing for musical instrument, guitar or DJ equipment. You know, when you go to the club, the DJ equipment, those things, they make it. And also some pharmaceutical devices like ultrasonic, and also the smart meter, those kind of things. You know, the market size is considerably smaller, but they have this technology and integrating skill throughout the history, and also good, very good management. I have to say that Hong Kongese guys and has been working in the industry for decades. So I think, again, this is the case where we try to leverage the family behind to help us to weather the storm and looking for the business opportunity to grow globally. Yeah. So, well, I think we're gonna end here for the glance, and maybe we can move on to the investment case. So next page, please. Yeah, here we go. So let's talk about CK Hutchison. So I think in summary, you know, this is a typical investment case for us of the holding company, where the company is listed in Hong Kong. It is not the most popular place for investors to looking for ideas these days, Hong Kong. And then they have global business portfolio that is too complicated for one analyst based in Hong Kong to cover all of them. Can you imagine a Hong Kong analyst researching on European telecom and the global ports, container ports, and then the infrastructure business in UK and Australia, and then finally a Canadian #1 energy company. So I physically think it's not a very popular job for anyone to do. So let's look at the portfolio here. So in this chart, I try to show you that on the left-hand side is the EBITDA by region. So #1 contribution, Europe, 60% almost. And then the #2 is Asia, Australia, and others, basically. And then on the right-hand side is the split by business. So it's very diversified. You know, the #1 is telecom, which is 1/3, and #2 is infrastructure, is the other 30%. And then you have port, retail, about 15%. Lastly, you have 10% for investment and others. So I consider this is a very you know, diversified business. Sometimes cycle up and down, but they balance each other. So it's very stable. And then they are present in here and there. Well, they are not big way in US, but they are almost present in all the other important countries in the world. And for example, in Europe, you can see that. So in the middle, the line chart in the middle, Europe. The most important thing is telecom. Basically, here you have a 3 group, which is, sorry, the name is 3 group, and they are basically in UK. They are one of the mobile supplier in UK. I think one of the 4, and they are, I think, in talk with Vodafone for a merger. We will see whether that will happen or not. So that's the UK, and they are also present in Ireland, very profitable business. And then they have presence in Italy. They bought Win today and merged with Tre. So now it's Win today. They are fixed. They are both in the mobile and also the fixed part of the business in Italy. It's a very competitive market. So with Iliad there, they are trying to turn around the business. And then in the rest, Sweden, Denmark, Austria, a very small market, but very stable market share and very profitable EBITDA profile. So those are very healthy and stable business, telecom, basically. And then look at the 4th one, which is the, you know, in terms of geographic, the second biggest one, Asia, Australia, and others. Basically, here the biggest contribution is infrastructure. So if you think that in the UK, the water company, I think they have control of Northern Bird Water Company and Northern Gas Distributor Company and Power Network Company. So they are very important to UK, vice versa. And in Australia, they own the gas network in Victoria and NSW. So again, very important infrastructure in those very stable country with the regulation protection of either inflation or a cost, whatever cost that is coming in. So those also help us to, you know, fight for the inflation part of the business. And the other thing perhaps I want to mention is in a port business, they are operating 52 ports in 26 countries in the world. I think this is the business they start. So this is a history, a very long history. And in 2021, they handle about 88 million TEUs, containers, a year. So let's try to speak for the diversify and the globalize of the port business. And for the retail business, they are the world's largest beauty and healthy retailers. They have 60,000 stores, and mostly in Europe and in Asia, China and Southeast Asia as well, where the growth is very good. And they are present in 28 markets with 12 retail brands. The most important one is Watson's. If you've ever been to this part of the world, you will very easy to identify it. And they have 142 million loyalty members for their whole retail business. So all these are, you know, very easy to understand, diversify in terms of geographic and the business. But how about valuation? Let's see the next chart. So here is kind of sum of the part valuation that we made for CK Hutchison. And so simply put, the share price now is 40 Hong Kong dollar per share, and we think it was 120, so almost like 200% upside. And if we think, you know, if you just think the risk, there is an energy business here, Cenovus, okay? They used to have the other company that they merged with the other Canadian company. Now it become this one. This is the number one integrated energies company in Canada. So they have upstream, they have downstream as well. And then they, after the merge, I think they could start to sell the company since July this year, which effectively means this is one of the things, if they want to, they can sell. So, and imagine this is worth 13.13 Hong Kong dollar. And in the telecom business, they effectively try to monetizing their tower assets in Italy, in UK, in Sweden. Yeah, I think that's all. So, and for that, for those transactions, they use the cash to cut the debt, to cut the leverage, and also they have exchange with 5% stake in the Cellnex, which is kind of like the tower company, a high growth one, and that's the other 2 Hong Kong dollar per share. And then the infrastructure business, they have the other list company called CK Infrastructure, listed in Hong Kong, the biggest one, infrastructure business in Hong Kong. This is worth something like 20 Hong Kong dollar per share. So just with these 3 assets, they is cover the market cap, and then all the rest thing is for free. So it is, you know, you have one of the pole business that's globally more than 50 ports, largest retail beauty and healthy beauty retailer, and you have the telecom business in Europe, a little bit struggling, but the fact is it is what it is. They are one of the leading players in those countries that I just mentioned. And also, I forgot to mention, in Asia, they also has a very good presence. In Indonesia, where a lot of population there, they just last quarter complete this merger with the other number 1, and now they are the physically they do this in market consolidation in Indonesia, and then that's the other 15 Hong Kong dollar per share values in those Asian telecom business, which potentially you should have see more growth in future. So this chart is trying to show you how undervalued is the CK Hutchison. Also, secondly, how diversified the business is, and then how if they wanted to how liquid they could actually do something to narrow the discount. So why are they not doing that? I think it was to mention that they have been changing a little bit. In the past, the Lee family, by the way, I want to mention about the family, the Kashin. He was the richest person in Hong Kong, and at one point the richest person in China as well. And he has a history. He's, I think, more than 80, probably 90 now. He has an incredible track record in growing business, and very good eyesight in and buying cheap at a difficult time. That's how he built up this empire, like CK Hutchison. So so this could give us a kind of confidence that we want to rely on his view on he sees so much, he's in front of everything, and then he could feel the pulse of the global situation. So we kind of rely on the entrepreneur and the family for us to weather the storm and again find the opportunity in a difficult time like we are facing now. So perhaps I think I take too much time, but perhaps I just stop here. And then I want to convey three things with all this talk, that we always try to invest in company that first have a very safe balance sheet, so that we don't need to worry in a tough time. They will probably have more opportunity with those balance sheet. And secondly, we try to find company that in the good hand, means with a family behind, with entrepreneur. They always invest in the long term because they always try to see for their family in the long term, and that's the way we see our investment also. And thirdly, when possible, we try to find a business that give us a very decent ROCE. In most of case, that's what we are trying to do. And lastly, we are we pay a lot of attention to the valuation. So we always invest in company with a decent valuation. And just as you see that the Asian one is below four times PE, and all the other portfolio in Cobas fund is a very similar idea. So yeah, that will be ending my part of this. Thank you. Arvin, to you.
Okay, thank you very much, Mingkun, for the explanation. Before going to the Q&A, we'll like to share with you some conclusions about the whole portfolio, where these Asian companies, great Asian companies that Mingkun has just talked about. We have a portfolio which is inflation ready, as we talked before, with high exposure to energy, which is a great hedge, wide discount to the asset value, and very deep knowledge of the company. So at some point, this high upside could be reached in any market environment. So now let's go to the Q&A. I have the first question, which is not about Asia, but it's could you explain why the PE of Danieli is of 0?
Okay, I will be guessing. So the question must be for Ivan, but I will be guessing because of net cash position. Because yeah, I think
if I remember,
this must be the EV.
Yeah, I remember that they have also the same amount in cash than the valuation or the market cap of the company. So it has to be that.
Yeah, so. I guess so, because in Hanaud's case, it's below 1. It must be also the net cash, also the finance business they have, and their stake in the Nissan, which currently we finally see some positive development in Nissan. They are finally, the three parties start to talking, and perhaps with the potential to dissolve this cross-holding structure, which is very positive.
Mm-hmm. So next question is why we do not have any investment in China?
Okay. Well, let me try to think this way. So we first it's about valuation, okay, and then and it's about the comparison with other company in our portfolio. So about valuation, and in China, if you're talking about mainland China, A share, they are good company, but when they are very good, they normally trade at a very high valuation. We talk about incredible brand, but more than 20 times PE. That's not investable for us. And for some very cheap company, I have some doubts. The history normally is not very long. Perhaps they only list for 3, 4, 5 years. So that doesn't give us enough time to see the history of how the business developed. And also, there are not so many company that we tend to think we invest in company that has history and then their business in China. That is kind of, we trust the family first and then we see the business. Well, not the first. There's no priority, but perhaps I will just say that the first valuation, and then compared to our portfolio, which is incredible, and then we are now energy is very important thing, and in China the energy sector is basically state-owned, so that's the other thing that we probably don't want to partner with the state. Normally that we don't want to partner with the state company. Yeah.
Okay, thank you very much, Mingkun. And we have a couple of questions about CK Hutchison. So I'm gonna ask you both together. So first question is, CK Hutchison multiple price to book value has continuously been falling for years, now at approx 30% of book value. Buybacks have not been aggressive. Is taking a private transaction an option for the family? And how do we look at all these realities? And the next question, and that can be related with this one, is why the market has penalized CK so much during the last 5 years.
Okay. Yeah, I see. So yeah, that's a very similar question to many Korean company, and I have to say there are a couple of reasons. Well, first, I don't know because only market know. But my guess will be, first because they list in Hong Kong, and then there are very many foreign money are leaving Hong Kong. That's one, and also because this is a little bit political, but they consider their business is kind of old style, old fashioned. They like those fast growing and the high tech, like network internet company like Tencent, Alibaba, whatever. So basically, what I have been heard is number one is listing Hong Kong, but the business is too far away. We don't understand. And secondly, the business is very old. We don't like telecom. We don't like port. They are very boring business, so no interest. And then perhaps we have to say that telecom is one of the drag for a company for the last 5 years because the European telecom sector, to be frank, for the last decades, I think has been not generating economy return for the investor. So as you can see, this is the biggest, although only 1/3 of the profit. This is the biggest profit contribution to CK Hutchison. So when people talk about CK Hutchison, they think about the telecom right away. They think about three group in UK or Wind3 in Italy, and they just interpret it as a telecom business. That's one. It is true that the business is very tough there, and they try to stabilize in the profit there. but you know, it's 1/3 of the value. You cannot ignore all the other 70%, right? So I think that's 3 reasons I've been heard that I will recognizing as part of them. And for the private, well, that's not the question for me, perhaps for the family better. But my sense is they always want to be a listed company because they like to do deal. And then, and that's important for them to make their valuation good in order to financing from the market. So that's also raises the question why they change, because in the past, they never do buyback. That was the first time they do buyback with the money from the power tower company sale. They sell the tower company in Europe and they do some buyback, and then not big way, but at least this is a changing sign. So whether they will take it private, I don't know, but it's possible, no? Why not?
Okay. Thank you very much, Mingkun. Next question, I think, is one of the key questions when investing in Asia, and it's about governance. So one of the reasons why we find these low multiples is because this governance of the companies have. So you think the governance is improving in Asia, and have you noted any improvements since you started covering these markets?
Okay, sure. Well, I have to say, it has always been a problem for especially Korean company. In Japan, the issue is less the government, but more it's the other way, the other angle. But more they try to hover the cash, etc., and then they never give it very lousy shareholder return, etc. So I shall try to split in 2 parts. So in Korea, I do see that's improving. For example, in 10 years ago, it's starting. It's very interesting. It's even starting from the biggest company in Korea, Samsung Electronics. They used to have, you know, a big discount in preferred share, and then they know that this is nonsense, so they start to doing buyback, and then they even set a target for the buyback for preferred. So they say if it's 20% more, I will buy back preferred share more. So they guide the discount, and they do buyback. They have this program saying that every 3 years we review our program, that we commit half of our cash to investor. If we didn't pay you dividend, we try to buy back, etc. If we didn't do MMA, we will give the money to you back. So it's already starting from the Samsung Electronics, and then I would say gradually, you know, spread to other company. And it's very curious for me why the NAV discount of many Korean company are still very large, and not even large, they are widening. So it's curious. I could not explain much better than this, but I do see the corporate government is improving, at least in Korea, the way they try to benefit the shareholder, etc. Part of reason perhaps with the new generation, you know, getting in hand. For example, this is happening LG, Hyundai, Samsung. The current chairman of all of them is like the second, the next generation. They are in their late 40 or early 50, something like that. So they just take the emperor from their fathers, and then trying to figure out how to do the things and how to grow the business, etc. So I do see this trend is going, continue to go. So that's for Korea. And for Japan, it is notoriously, infamously slow in terms of the change in the shareholder return or governance side. And however, you know, if you compare to 5-10 years ago, it's still better. I will just point out that they are more activists in Japan than ever in the history. And for example, you see the headline that they actually broke out the Toshiba NAND flash business, with many high-profile U.S. hedge fund, private equity coming to Japan, and then set up their office and trying to find undervalued assets in Japan, etc., etc. So I do see that's kind of a new force, not new anymore, but 2 or 3 years already. But that force is there, and I think they will bring the change to Japan, but perhaps a lot more slower than many people expect, and also slower than the one in Korea, I will have to admit. Yeah, that's for Japan and Korea. All the other country, Taiwan was okay, I think. They pay dividend decently, and there's not huge government issue as well. Hong Kong is also fine. Singapore is also fine. And China, it has always has its own issue, and it's also political, and also the entrepreneur issue. But so I mean, we also have to take that into account, no? When we are investing, we also have to take if we can trust the family, etc. So let's say it is what it is, but we do see improving in Korea and Japan.
Okay, thank you. Next question is about energy. As you know, here in Europe, we're having a lot of problems with the price of energy. We're facing potential energy shortage. What is the current situation in Asia, and how it could affect to the global energy system, and how it could affect also to our investment?
Okay. I think, well, in general, I think the big thing happened this year was, Europe start to buying a lot of LNG globally. So let's kind of speed up the price and squeeze out the Asian buyers, let's say. So there are two options for them. Number one, the one who cannot pay or who don't have enough foreign exchange to pay for the higher price go bankrupt. I think Pakistan is one of them. And then they have either borrow a lot of money or basically try to switch to other things like the traditional coal or whatever. And then that's one. And the other things is in China this year, I think they're gonna the import of energy gonna decline a little bit because of this what we just mentioned. As also because the demand is weaker, because of these COVID things, the demand is kind of weaker than last year. And with the Russian gas coming from the pipeline, and also the sale, they also have produced themselves every year grows like 7-8% of gas. So this year they do reduce the import of LNG. That's one, that's for sure. And in Korea and Japan, for example, in Japan, they start to think about the energy security issue. So they are trying to push out the retirement or reactivate some nuclear power, and even try to push out some retire years, legal regulation years for those reactors. So we do see some kind of a nuclear renaissance in Japan for sure. Korea a little bit similar like Japan. I think I also read something about Korea. They are trying to do this. In Taiwan, they are doing more the offshore wind. In fact, they have added a lot of offshore wind in the last couple of years. So I think that's a situation, the reality is the price is so high, so you don't buy spots, and then you need to find something else. And I think this also actually push to some extent to push China to incentive more coal production, which is very counterintuitive to our least environment goal in the long term. But I do see this is what is happening in China now, that they are trying to produce more coal to avoid power shortage in the summer and now in the winter as well. Yeah, so that's what I see in Asia, that impact from the Europe crisis.
Thank you very much. It's been over an hour now, so one last question. And And we finish it. Several of our companies are cyclical in Asia. So in what part of the cycle are they in now?
Well, it depends on which company, you know. So for example, if I just go back to the slide where we have the list of company we own, the first one is Samsung. So basically, let's talk about memory. I think we are in a low cycle, you know. The demand start to weakening very suddenly, early, perhaps just after the summer, something like that. You know, in the first half, things was still okay, but suddenly it slowed down. But you know, the supplier start to adjust their production and the capex plan very quick. So I think we expect to see the recovery, the bottom of the cycle, perhaps early next year, and then the second half will be a better recovery. And for LG, I think it's more about appliances. I don't know how long it will take, but we do still see some inventory in the channel. So perhaps it take a couple of quarters. It's already done for half two or three quarters. So, but we need some time to do the destocking. I think Daiwa, there's no issue about the cycle. It's kind of very stable one. And CK Hutchison, too many business. So and Hyundai Motor. So this is certainly probably one of in the higher cycle one. You know, the auto company are reporting a record profit this year. The question is next year and afterwards, if the demand destruction from the higher inflation happens, perhaps the auto volume. Here is something that we could debate. Actually, even internally, we have been debate this for quite a while. That is, how do we see the auto volume demand coming forward 1-2 years? The positive thing is the auto fleet is very old now, and just to replace demand could probably support a demand there, because if you remember the demand already coming down from 2019. In 2021, 22 is already relatively low, so it's already in the lower cycle for a couple of years. So we should not expect a big level down, you know, in the next few years. While the other counter argument is this is a very probably the second most expensive item anyone will buy in their life except the house. So if you can postpone, you will try to postpone, right? So and then with the inflation eating up your income, perhaps this is one thing that you will try to push a little bit forward for purchasing. So this is something that we don't know, and effectively this is why it's present opportunity for us to buy. If I just want to mention in this list, the Johnson Electric and Ichigo in the last button 2 company. This is a new company that we add recently. Remember, we add some cyclical in exchange for some energy, and this is the typical case. You know, in a situation where we are not so sure about the cycle, where the cycle will be going, and the market is not so clear. Normally, the market over penalizing the bad news. And then at the same time, that present us with opportunity to buy company that safe balance sheet and the family own and they have order book, but with uncertainty. So those are the typical case that we buy here, you know. And so let's answer the question why where is the cycle for these two? You know, is along with the auto. Oh, sorry. But they are parts company, so they are suffering from the semiconductor shortage for these years. But now with the shortage getting better, so next year the shipment will be better. So perhaps they will be better than the auto makers. The parts will be better than makers next year. Yeah, that's a very quick overview on that.
Okay, we have a last question because I just received one question and it's about ESG, and it says what's the current situation in Asia with the ESG compared to Europe?
Let me think. It's difficult to compare Asia versus Europe. I think you have to really compare between company to company. For example, first, number one, the trend is there that every company that makes sense, that all spend tremendous efforts on the ESG side. For example, I seldom read 3 years ago, even just 3 years ago, I didn't see many ESG report that the company published to emphasizing what they are doing for the ESG, for the environment, for the CO2, etc. But nowadays, the company list that we're talking about, I know CK Hutchison has this one, Samsung CNT has this one, LG has it, Taiwan no, Hyundai Motor yes, Okamoto no, VTech yes, Johnson Electric not sure, Ichigo not sure, Amu Pacific yes. So more than half, perhaps 60% of it, they have ESG report and they do mention what their efforts in this part of the spectrum. So I would say the trend is they are improving, and then but if you want to try to compare to European one, you really want to see apple to apple by company. I think that will be making more sense for me.
Okay, so thank you very much, Mingkun. Thank you very much, everybody. We will share this presentation with you. And of course, if you have any additional question, just let us know and we will be more than happy to answer. Thank you very much. Have a nice day. Bye-bye.
Thank you. Bye-bye.